This is a Yahoo Finance special real estate report. It's set to be a tough year for the housing market. Higher mortgage rates, the threat of a recession, and tight inventory, all hitting home buyers. But home prices are expected to fall sharply this year. Which parts of the country are most vulnerable, and who will feel the pain the most? Over the next hour, we'll take a look at what's ahead for buyers, sellers, renters, and investors, and where home prices are headed in 2023. Also, remodeling and renovating. When does it make sense to just stay put? Join us right now for this Yahoo Finance special Real Estate Report.
Welcome to this special edition of Yahoo Finance Live, brought to you by Intuit TurboTax. Now, over the next hour, we'll be breaking down what you need to know about buying, selling, and renovating a home in 2023. Let's start with this map right here. Now, what you are looking at is at all the top real estate markets to watch. This is according to the National Association of Realtors, and Dave, weigh in here, because my first take, obviously a lot in the South, but 3 here in the Southeast.
Yeah, what really stands out is what is not covered on this map. Basically anything west of the Mississippi, the entire West Coast is left out. Also New York, Boston, Philadelphia in the Northeast. And why is everything converging in this basic region? No matter what list you see, it's based on 3 things: affordability, jobs, and of course, quality of life. And that comes down to weather, that comes down to outdoor things to do, and that comes down to even the commute that you're not having up in the Northeast and in California. And that's why all the top 10s are centered right there. Yeah. All right, one thing we know for certain is buying a house this year may be a lot harder than buying in 2022. Yahoo Finance's Ali Garfinkel spoke to some hopeful buyers and real estate experts about what it's like navigating today's market. What did we learn?
Hi, Dave. To put it simply, it's rough out there. Here in Southern California, I'm standing in front of this sign that's a for sale sign, right? Part of the problem is there aren't enough signs like this. There's, to put it simply, a massive inventory problem. So what's happening is that it's making things even more difficult for home buyers. Take a look.
We've been looking for a home for, I would say, 2 years, more or less, give or take.
Danielle Cohn and her husband David Jarvie from Los Angeles are facing the same dilemma as home buyers across the country.
It just came to a grinding halt when interest rates went crazy, and now we're just not finding a lot on the market. So
I think a lot of people right now are afraid to list their house, so if they don't have to, they won't.
The average 30-year fixed loan is hovering around 6.5%. But as the Federal Reserve pulls back on the pace of its aggressive rate hikes, the Mortgage Bankers Association expects the 30-year fixed to drop to 5.2% by the end of this year. That's well below the historical average of 7.75%. Ed Fitz is a real estate agent and partner at the agency in Los Angeles.
Buyers are really holding off at the moment for a variety of reasons, including the new interest rates that's changed things dramatically since last spring. Nobody quite knows where the market is going next, either in Los Angeles or California or even nationally.
Also freezing the market, sellers are reluctant to drop their prices. In real estate, the asking price is often as much about psychology as it is about reality. Fitz has gathered data on this through an app he launched called Domicile Game of Homes, sort of like The Price is Right for real estate.
People who are not actively in the market, who are just guessing the prices, what's the asking price, what's the ultimate selling price, are guessing higher than the house actually sells. The mind of the average consumer hasn't caught up to the realities of the market right now.
But sellers are being forced to cut prices. Realtor.com estimates 1 in 5 sellers nationwide are lowering their asking price. The states with the biggest cuts, the western part of the country. Arizona, Nevada, and Utah topping the list. Realtor.com predicts the 2023 housing market could become a nobody's market, not friendly to buyers nor to sellers.
Every time she's around, the energy changes.
We caught up with Jason Oppenheim, star of the hit Netflix series Selling Sunset.
I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic, but I don't want to pretend that that means the real estate market's going to be, on the ascent.
For Danielle and David, they're hopeful they'll find a great home soon.
yeah, it's just waiting.
But the higher interest rates definitely affect buying power, right?
Yeah.
So the reality is this: while it's incredibly difficult to find a home right now, it's not just a matter of finding your dream home, it's a matter of completing the process altogether. Back to you in the studio.
Certainly isn't as tough in this environment. Ali Garfinkel, thanks so much. Well, it is a new year and you may be interested in a new house. Mortgage rates have cooled demand for homes. The number of homes sold is down 37% from a year ago. That's according to Redfin data. We want to take a deep dive into housing markets across the country and take a look at Denver, at Indianapolis, and at Charlotte. We have Kathy Casey, Coldwell banker, residential brokerage realtor in Denver, Colorado. Dan O'Brien, realtor at Trueblood Real Estate covering Indianapolis. And Sir Ashley Harrison, real estate broker at the Harrison Group with Fathom Realty in Charlotte, North Carolina. It's great to have the three of you here. We want to jump right in and get to what you're seeing in your respective regions. We're going to go around the horn pretty quickly. Kathy, let me start with you. What are the trends? What are you seeing in Denver?
So Denver, our market is cyclical. So typically the spring market starts in January. So we are already starting to see signs of the spring market showing that it may be a heated market. In December, the market was kind of slow and buyers really were taking their time. They were able to really pick and choose what they want, and they were asking for seller concessions and the contingencies that they haven't had the luxury to be able to ask for in the last couple of years.
Dan, what about you? What are you seeing in Indianapolis?
Yeah, things have certainly slowed down since the craziness of the COVID market, right? So things are lasting a little bit longer on the market. Days on market is up, but the median sales price is still up 9% or so year over year. But buyer demand has certainly slowed down with those rising interest rates. And so it's one of those things where we've been seeing new listings coming on the market, but they just take a little bit longer. And the question, like you were talking about, is do sellers, reduce the price? Do they play the waiting game? So we anticipate still a busy year this year. And, time will tell to see what happens.
Sir, how does this compare to what you're seeing in Charlotte?
Pretty similar. We're seeing more inventory, but less new listings, and buyer demand has fallen off, and we are getting a lot more seller concessions, but pricing has remained very sticky.
Sir, I want to stay with you because we mentioned the top 10 markets all basically in your region. North Carolina is on fire. What do you make of it? What makes North Carolina such a perfect storm for real estate markets right now?
Well, affordability. You named it earlier in the segment. Affordability is the driving point, and a lot of industry is coming to the Carolinas and North Carolina in particular. Just this past year, North Carolina was ranked #1 by Wall Street Journal as the #1 place to do business. So I think that's the main driving point.
Kathy, when you take a look at Denver's housing market, it's incredible taking a look at the prices because they have certainly exploded. They're up 30% when you compare it to the levels that we saw back in March 2020. What is that doing for demand? And I guess, where do you see prices headed? How long until they really come back down?
So, our prices luckily have been pretty much holding steady. I mean, we lost about 5% since the interest rates started to have that uptick. But the prices are still holding steady because inventory is still low. So, for buyers, this is a great time because now, the line's not as long for you to get into a house. So you can get into a house much easier than you could months ago. And, we have a saying in our industry that is, date the interest rate, marry the house. So go out, find a house that you like and you love, and then, wait till, you can get that interest rate at, that's more for 30 years, that's going to be more appealing to you.
The inventory story has been bleak across the country at best. However, not necessarily the case in Indy. What are you seeing there, Dan?
Yeah, so year over year, we're up 75% from this time last year. However, to put that in perspective, we just now broke, the number where it was pre-COVID. So before March 2020, when the market went crazy, we're just now getting back to then. And at that time, we were talking about low inventory anyways. So, a lot of people talk about the last 6 to 12 months, but putting in a big picture view, we are still, low in inventory. It is technically a seller's market, but things are looking pretty good leading into the year.
So you're right in the middle of one of the hottest housing markets, if not the hottest housing market. What are some of the tips for people who are interested in or maybe looking to buy in Charlotte?
Yes, I say right now, if you have been on the margins and could not get your offer accepted in the past 2 years, now is the time to move. Although interest rates are a little higher, you're not competing with as many people. So the sellers weren't considering your offer. Now they will consider it, and they may offer seller concessions.
Concessions have been a theme across the country, just like low inventory. Redfin says 42% of home sales in the fourth quarter gave concessions. Kathy, what type of concessions are sellers forced to offer right now?
Right now, sellers are offering to help with the interest rate increase. So they are offering 2-1 buy downs. And if you don't know what that is, basically what that means is for the first 2 years, your interest rate would be lower than it would lower at the market rate right now, the current market rate. So they're offering that. Typically, that costs somewhere between $10,000 to $20,000, depending on how deep they want to cut the interest rate. And that's what's really helping buyers really get into the houses that they want to, because affordability is key here in Colorado. Just to give you some perspective, our home prices have doubled in the last 10 years. And so, wages just can't keep up with that. So anything to help the buyers get into the house is what sellers are doing right now.
Dan, what about concessions in Indy? Is that something that's becoming more and more popular? And what are people offering?
Yeah, same thing here. People are getting creative with the mortgage lending. Different banks are offering different types of mortgage products to help with that increased mortgage rate. Also, sellers, again, similar, are offering a credit for a 2-1 buy down, or just in general to buy down the interest rate to make that more affordable for a buyer. Now we actually have buyers that are being protected by contingencies like inspection and appraisal, where a lot of times those were out the window during the peak craziness of the COVID market. And so it's not getting too crazy or anything like that, but sellers are absolutely having to negotiate. Gone are the days of, hey, my next door neighbor just sold last year for $100,000 over list price. Things are still happening where there are some hot areas that are demanding multiple offers in a matter of days, but sellers are having to actually come back and come to reality with negotiating like they used to.
Sir, what are you seeing in terms of concessions, and what in this market, as we're coming out of COVID, really with the new dynamic, what's the number one thing you recommend that helps move a house today?
Yeah, thank you for that. The concessions I see are paying for closing costs and to buy down the interest rate right now. And it really depends on the loan the buyer's getting and how much concessions they can ask and seek from the seller. The main thing I think buyers can do moving forward is to, one, study the market. Know exactly what's happening. Don't assume just because the market is totally different than last year. Study the market, but also surround yourself with trusted professionals. That's the biggest thing.
Kathy, investor activity has been a huge story when it comes to housing. A lot of the pricing being driven by the jump that we certainly have seen in investor activity. How much of that are you seeing in Denver?
Well, I can tell you, I probably get a call, at least 3 or 4 calls a day from investors wanting to know if I have anything off market that they can fix up and flip, because it's really that tight for investors right now to find anything where they're going to be able, and pricing is kind of a guess, and not only say a guessing game, but you have to be really strategic. You have to really know how to price things. So investors, want to make sure they're going to be able to get that return on investment. So if they can't get it for a really just awesome price, then, it's really not worth it to them, because the uncertainty of the market has got them a little wavering in their decisions for investing into the market right now.
Dan, what's the investment activity in the Circle City?
Yeah, it's been very heavy. It's jumped from, I think in 2020, it was about 8 or 11% of the purchases were to investors, and 2022 is over 25%. So 1 in 4 houses is being sold to an investor right now. And you have some of these billion-dollar companies, Cohn, BlackRock, all these people with billions of dollars, and they can park it into a hard asset like real estate. And it's made it really difficult, especially for first-time homebuyers, to compete with these all cash, no inspection, no appraisal offers. And it's also made it difficult for the rental market as well. well. Rent is up, 20% year over year. And so it's been a really difficult thing to combat. How do you, can you create laws to prohibit some of these big billion-dollar companies from doing it, but not impede on individual rights for, people that want to own investment properties as financial planning? But investment has definitely been a difficult topic here recently.
It's certainly amazing to really take a look at the uptick in activity. We want to go around the horn once again. Quickly, just get your thoughts. Sir, first to you, your top prediction for the housing market this year.
I think interest rates will come down to the low fives, but it'll be harder to get a loan. And it's going to, at least in my area of the country, prices will level off, but tend upward.
Kathy?
So I predict that we have about 90 days of this interest rates will still be kind of maybe even on the uptick. And then I think that they will start to come down as well. And I believe that our prices will continue to hold. And so if you're looking to buy, don't wait, because you want to get out there before the rest of the market jumps back in. That's been on the sidelines.
Dan, you got the final word, your top prediction for 2023.
Yeah, very similar. So I think mortgage rates will level off, come back down towards the end of the year. Buyer activity will then pick back up. I don't anticipate any kind of decrease in value, anything like that, maybe plateau, but normalize back to a normal level.
All right, Dan O'Brien, Kathy Casey, Sir Ashley Harrison. Nice to have the latest from Indianapolis, North Carolina, my hometown of Denver. Thanks to all of you. Coming up, Jason Oppenheim, founder and president of the Oppenheim Group and star of Netflix's Selling Sunset, gives us his take on the luxury real estate market. Don't go anywhere. Quick though, before the break, let's take a look at our real estate snapshot of El Paso, Texas. El Paso's median home price of $241,000 and median rent of $1,600 makes this Texas border town one of the most affordable cities in the United States. We're back in 2 minutes. When it comes to real estate, everyone is feeling the pinch of the economic downturn, and that includes the luxury home market. Our own Allie Garfinkel caught up with Jason Oppenheim, the star of Netflix's Selling Sunset, to get his take on high-end housing.
We're here with Jason Oppenheim, owner of the Oppenheim Group and star of Selling Sunset on Netflix. But before we get to Selling Sunset, we're gonna talk about selling real estate. So what I've been hearing is a lot of doom and gloom in the market. Give us a reality check. What are you seeing out there?
I'm not the doom and gloom type. I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic, but I don't want to pretend that that means the real estate market's going to be, on the ascend. I'd say we're probably in for like some type of homeostasis, like just not much growth, probably not much, downward either.
Do you think, you said so we've kind of reached what might be a homeostasis too. For you in your business day to day, what does that look like?
Well, we're going to have a rough couple of years, I think, because volume is down. So when I look at real estate, I guess there's two things: prices, which is really what the people care about, and then there's volume, which is what real estate agents care about. In terms of prices, I think there's going to be some stability, which is probably healthy for the market. We can't have that kind of, we don't want the spikes and downs. So I think we're going to see a relatively healthy market over the next few years in real estate as it relates to prices. And we've got a lot of people that own homes that have very low interest rate loans, and they're not going to be selling. So we're going to have low supply generally, probably low-ish demand.
What are kind of some of the concerns you're seeing that transcend income brackets?
Interest rates largely transcend income brackets, although I think affect more the lower income brackets. That is really the hardest. I mean, people talk about affordability of homes. Really, it's the down payment. You got to come up with a down payment. That's always been difficult. But now not only do you have the down payment, now you got to pay a 5 or 6% interest rate, even on a 5 or 10 year fixed. I think that will come down in the next couple of years. So I don't think it's a big deal if someone goes in and buys a house and has a 5% interest rate. And I don't recommend people getting 30 years anymore. You should probably get a 5 year. Probably you're going to be able to refinance in a few years. And buying's always better than renting if you can hold the asset and you can ride the ups and downs, and you can take advantage of the appreciation over a decade or 2 decades or hopefully 3 decades. Then I think buying really always makes sense. Doesn't make sense always in the short term. You've got transaction costs, and you're limited in your mobility when you're an owner. You're dealing with a lot of hassles when it comes to the roof leak. It's not the landlord's fault anymore. Now it's your problem. So if you're looking to own and just for a couple of years, probably consider renting.
And here in LA, where, when people are buying now in the situations where they are, where are you seeing the money come from? What professions generally are they in? Are there any kind of trends you've seen in the cases where people are bucking the overall slowdown?
There's a lot of wealth out there still. So, I'm not concerned about the luxury market. Honestly, I'm not even really that concerned about any of the markets. There was an open house yesterday for a $1.6 million house up in the hills. 300 people came by the open house in this environment with these interest rates. So there's still demand out there. I think it's good. 2 years ago, even a year ago, everything was selling. I don't think that's healthy. I mean, crap was selling. And I think that developers and people should be building quality product. And I think people should be more discerning and not being, a year ago, literally you'd get 10 offers on a crappy house with no yard. Now, I think, again, it's back to a healthier market.
My sense that what I'm kind of getting from you is that despite the doom and gloom narrative out there, there is right sizing happening, and there's also a lot of reshuffling going on from where you sit.
Yeah, I think COVID changed a lot in our psyches. The at-home work, people focusing more on the house, more willing to move out of the city. You look at some of these states that, were laughed at a few years ago, and now they are, where everyone's moving. Austin, Texas, and Miami, and Las Vegas, and like Scottsdale, Arizona. These were not places people took as seriously as they do now. And that trend is not going to, obviously we're going to see some people coming back into the big cities. I think New York and Los Angeles will be fine. And I think those cities will have some difficulty the next couple of years, but they're on the map. And now there's competition. You don't have to live in LA, you don't have to live in San Francisco, you don't have to live in New York. You can now live in these other cities. And I think that's going to be a draw away from some of the big cities if we can't get a handle on some of these macro issues that we're dealing with. I hope that we can. Like I said, I'm generally an optimist. I think that people that make money in real estate and pretty much anywhere have to be optimistic.
And last thing I wanted to ask you, Jason, in the middle of all this, right, Selling Sunset blew up, Right, I'm sure you haven't been asked about it ever.
Yeah. I'm just surprised it took this long.
It took this, yeah, what can I do? What can I say? I wanted to surprise you, but my question is actually not about selling Sunset itself, but why you think it was so popular.
I've thought about that, and I think it's because it checks a lot of different boxes for a lot of different people. And I realize that because of the people that come up to me. It's such a wide swath and a different demographics all the time.
How wide are we talking here?
I mean, you just wouldn't believe. Well, to every country I go to, I've probably been to a dozen countries in the last couple of years. And it's just every age group, every ethnicity, it could be from like a football player to like a 7-year-old girl to like a 85-year-old man. I mean, it's so weird. So I think, again, there's different check boxes. Real estate is just fun to watch. That's my favorite thing about the show. And I think that's probably what ties in so many different demographics of people. Then I think the beautiful women and just the beautiful women. And the fashion, I think a ton of people love the women's fashion, and I'm trying to do what I can now. Los Angeles, Sunset Strip, all the kind of restaurants and nightclubs and lounges and cafes and that kind of thing. So and then of course there's the real world drama among, successful, beautiful women that are really striving to, take control of their careers. So there is a lot for everybody.
Thank you so much for joining us, Jason.
Yeah, my pleasure. Thank you for everything.
That was founder of the Oppenheim Group and Netflix's Selling Sunset star, Jason Oppenheim. Well, coming up, it's one of the biggest issues facing the housing market right now, higher mortgage rates. Our next guest tells us what buyers need to know. Stay with us. Welcome back to our real estate report brought to you by Intuit TurboTax. Mortgage rates, they soared in 2022, the largest yearly jump on record. And those rising rates are keeping many would-be home buyers on the sidelines. So let's put all of this in perspective for you. The latest data out from Freddie Mac showing that the rate of a fixed 30-year mortgage is now at 6.33%. That's nearly double what it was a year ago when it was at 3.45%. So here's what this means for you, the potential home buyer. We use Bankrate's mortgage calculator, which takes into account a number of variable costs, and those include credit score, property tax, and also homeowners insurance. So say you're looking to buy a $500,000 house, putting 20% down, which means that you're going to be paying $100,000 up front. That means that your monthly mortgage payment would be $2,878 a month. But if you bought that same $500,000 house a year ago when the rate was almost half what it is today at 3.45% and you put 20% down, once again, your monthly mortgage payment would be $2,180 a month. That's a difference of $698 a month, $251,000 in interest over 30 years. When you take a look at those numbers, take all of this into account, it's no surprise that the sharp rise that we're seeing in borrowing costs driven by the Fed's rate hikes has certainly cooled the housing market, David, and has put home ownership out of reach for so many people.
Right. On the other hand, they are relatively low historically speaking, as just most people forget how high they were some 20 years ago. Shauna, excellent work. Let's talk more about mortgage rates with Melissa Cohn, William Raveis Mortgage Regional Vice President. Melissa, nice to see you. Thanks for coming on. Where do you see these rates flattening out, and what do you think will be enough to really thaw what has become a frozen housing market?
Well, I think the good news is that we are seeing that inflation is moderating and cooling, as we saw this morning with the CPI number. And we're seeing other signs of weakening in the economy, and that means that bond yields are coming down. The 10-year Treasury was at a 3.45 the last time I looked at it. And, mortgage rates have declined by almost a full percentage point since they peaked in November. And I think that we can expect mortgage rates to go down another quarter or even as much as 0.5% over the course of the next month. It's the beginning of 2023. Everyone is back to zero in terms of meeting their goals, and everyone has to bring loans in the door. And I think banks are going to sharpen their pencils. They're going to tighten up their margins and do whatever they can to bring volume in the door, and lower rates will bring, more real estate transactions. We also saw another figure that refinancing was at the highest level it's been in a while as rates have declined.
Do want to follow up on that refinancing in a second, but what would you tell those buyers who have been sitting on the sidelines waiting for rates to return to that mid to low 3 level in order to get back in on this market?
Well, I think people can't expect that we're going to go back to a 3% 30-year fixed rate. That happened because of COVID and the pandemic, and we don't want to find ourselves in that position again. If we can get interest rates to go back to where they were pre-COVID, call that anywhere from 3.75% to 4.5%, that would be a home run. But buyers need to, my favorite expression is you marry the house and you date the rate. So they want to find a way to get into the house today. You'll generally find that when mortgage rates are higher, that real estate prices tend to be a little bit softer. And when interest rates do come down, and they will come down more than just 1/4 or 0.5% over the course of the next year, year and a half, real estate prices will start to go back up again, and there'll be more competition for the homes on the market.
Melissa, for the first-time home buyer, I think applying for a mortgage sounds very daunting. A lot of people don't know where to turn. What is your advice to that first-time home buyer in terms of what they need to know when doing that?
Well, I think that they need to, first of all, be willing to take into consideration looking at an adjustable rate mortgage. Looking at a 5 or a 7-year adjustable, that means that rate's fixed for the first 5 or 7 years, and it's the same thing as a fixed rate for that initial period, but the rate is going to be lower, and it'll make the home that much more affordable. They also need to make sure that they've done everything to keep their credit scores as high as possible, because in many banks price rates based on someone's credit score, and to make sure that they have sufficient money for the down payment and for reserves. We find a lot of first-time home buyers getting stuck because they maybe have enough money for the down payment, but haven't taken into consideration all of the closing costs and what you need to have for reserves. And the last thing is, in terms of looking at your credit, make sure you have enough credit. So many people today, especially younger people, tend to live off of a debit card or perhaps just one credit card. And many of the banks with better rates are going to want to see someone having 3 to 4 different active trade lines on their credit history.
Those ARMs adjustable rates certainly come with the downside. What's your word of warning to people that do go that route?
Well, I think the risk that you have with an adjustable rate is that either that you've had some sort of negative work issue where you no longer qualify to refinance, or for whatever reason, if the value of that home drops, you may not have the equity to refinance. But if you're locking in for, I say a 7-year adjustable is a safe period of time, you're going to mitigate those risks. Really the goal is what can you do to get into a house today, and then be prepared to refinance when fixed rates get down to a more acceptable level if you think you're going to be in that home long term. Most first-time home buyers are not in their home for 10 or 15 years. The average, tenure of that home is probably closer to 7 or 8 years.
Well, so going back to that advice here for the first-time home buyer, you mentioned the down payment, how critical that is. People need to think about not only what they're putting down, but also budget for what they will be paying on a monthly basis going forward. 20%, that often is the number thrown out. Is that the best number, aside from obviously an all-cash offer, for a person that is buying a house to put down?
Well, the benefit of putting 20% down is that you don't have to have the mortgage insurance. So that saves you on a monthly payment. If you are a first-time home buyer for a conventional loan, which now goes up to $726,000, except in the high-cost areas where it's even higher, over $1 million, you can put down as little as 3%. But you obviously, the less you put down, the higher the payment and the higher the mortgage insurance that you're going to have to pay on top of the mortgage payment, the insurance, the taxes.
Melissa Cohn, William Raveis, Mortgage Regional Vice President. Thanks so much for joining us here this afternoon. Well, coming up, a new survey finds that more homeowners would prefer to renovate their homes than move in the current market. We will break down the latest home remodeling trends with Dave Mars of HGTV's Fixer to Fabulous next.
is what I'm talking about. The house didn't come down. That was a great start to the job.
That was Dave Mars, the co-host of HGTV's Fixer to Fabulous, alongside his wife, Jenny. Now, for 4 years, the couple has taken us with them as they update and transform classic homes in their hometown of Bentonville, Arkansas. Dave Mars is here to share his knowledge as a builder and general contractor to tell us everything that we need to know about home renovations. Dave, it's great to see you here. Certainly, we have seen a massive uptick in people wanting to renovate their home. There was a recent Discover survey out finding that 79% of homeowners would rather renovate their homes that they move the homes that they're in right now than move. I'm curious to get your perspective on this as a home renovator. What are you seeing, and how big of an uptick have you seen in activity?
So hello. I could not agree with you more. The amount of remodel calls that we are getting now compared to even just a couple years ago it's just significant in so many ways. And I think, like the last person that you had on, interest rates is one of those big things that, these people are in these homes at 3 and 4%, and they just don't see, they can't move to another home. So they're renovating what they have.
And we've seen the pandemic really shift where we want to live, but also how we want to live. What's the biggest change you've seen in the renovations people are asking for?
I think before the pandemic, you saw a lot more of people, they were in the bigger cities because that's where they worked. Where now, there's a lot of people that they can live wherever they want and work from home. So we're seeing a big, like people that their house was fine before because they were gone 60 hours a week. Now they're realizing, I'd really like to get that kitchen remodeled, or I'd really like to, make an office, make a space that I can work from. So I think it's more just spending more time in your home and realizing some of those things that you just had kind of lived with in the past that now you really feel like you should change.
And Dave, the cost of all this, we talk about it time and time again here at Yahoo Finance, inflation, the impact that has had on so many of your materials. How much more expensive are renovations today than they were 2 years ago?
They are significantly more. And I think it's everything like you're seeing in food, like you're seeing, in transportation, you're seeing it across the board. We have the same trucks that the diesel is higher. We have the same, import issues, the same, there's a lot more people in the past 2 years that were buying houses. So builders were a lot busier. So getting materials, everything's supply and demand in our market, and it's gone up a lot. Luckily though, with housing, that's usually people's biggest investment. And, even though the house prices have slumped a little bit here in the last few months, they're significantly higher than they were, pre-pandemic.
Dave, the cost of renovating is more, but the supply chains have also made it far more difficult. Are you seeing easing in terms of the time it takes to get the materials you need?
Yeah, we're seeing a little bit. You still, before the pandemic, you could order windows and 4 to 6 weeks have them, where it's double that now, but it's come down from 18 to 20 weeks. And so it is easing. And I think, that comes down to supply and demand with not as many homes being bought and sold. So a lot of that is helping. Our labor costs are starting to fall a little bit from what they were. It's getting better, but I still think we're just in a new normal from the pre-pandemic levels, and it's just higher than it was, and it's harder than it was to get materials.
Dave, if you're a homeowner out there, you're debating whether or not you should pour the money into a home renovation. When do you know when it makes sense and it will increase the value of your house versus when it doesn't make sense?
Right. So, number one, I would decide, do you want to live in this house? Do you want to stay here? And if that's the case, let it be a reflection of your family. Let it be something that you enjoy. You're spending a lot more time in it. And, Jenny and I always say, if you're going to just build a house to sell or build a house for someone else, that's fine, but we're really, like, a lot of the homes that we're remodeling and a lot of the remodels we're seeing now are people that they've found the area that they love and they've found the location that they want to be in with the community that they live with. And so there's so much value in that. So now they're just making the home a reflection of what they've always wanted it to be. And I think if all of those boxes are checked, then spend the money. This is, again, it's a great investment, something that is most people's best investment, and you're going to raise a family in there, so you better enjoy it.
Conversely, Dave, for those people that do want to make a renovation that they'll see value from if and when they do sell the home, what types of renovations best hold their value?
So, you think about a house, like what ages? I would say a bedroom never really ages. It's 4 walls. You can change the paint. It's pretty easy to do, but where your fixtures are, like kitchens, bathrooms, those are big areas that you can make improvements to where you can see the money, you can see the return on it. A lot of what we're doing now, we're doing a lot of exterior, a lot of patios, and I don't necessarily know that that's adding a lot of value to the house, but it's raising the standard of living to the family that is there because they're spending more time there. So, you've got to balance what, I think your enjoyment of the home as much as the resale of the home.
I bet you've got a killer patio. Can't wait to see that. I'm checking out your Instagram feed right now. Catch him on Fixer to Fabulous. He's the co-host, Dave Mars. Great to have you here on Yahoo Finance. Thanks, my man.
Thanks a lot.
All right, coming up, one area of housing that is starting to see some relief is rent prices. We'll break down what renters can look forward to this year after the break. But before we go to break, take a look at our real estate snapshot of Raleigh, North Carolina. With a median home price of $460,000 and median rent of $1,865 per month, North Carolina's capital city is still one of the hottest real estate markets on the East Coast in 2023. Stay with us. Welcome back to our Yahoo Finance Real Estate Report, brought to you by Intuit TurboTax. Renters may finally get relief in 23 as the housing market is expected to continue cooling in the coming months. The national median rent dropped for the fourth consecutive month in December, with overall prices down 3% since August. Here to explain is Yahoo Finance personal finance reporter Rebecca Chen. Rebecca, nice to see you. So what can renters expect to see in 23?
Yeah, so in 2023, most experts are believing that rent will drop and renter can expect some kind of relief. In December, we did see 4 consecutive straight months of rent declining, and that is probably one of the biggest drop we've seen since July 2017, almost 5 years ago. And as you can see, there's really 2 reasons why experts believe that rents could drop in this coming year. And the first is really, many of them are predicting some kind of recession, even if it's a mild one. A mild recession can have this impact on rent. Unemployment could go high and people could be saving more or more conscious of their budget. And there is another reason why experts are seeing some kind of relief coming in 2023, and that is the fact that there could be more inventory coming online for many of the cities in the United States. Construction activities has gone up in certain cities, and as that supply grows, we could see rent coming down for many in 2023.
And Rebecca, despite the fact that we are expected to see a drop here in rent on a nationwide basis, there are still certain cities, Salt Lake City, for example, where rent continues to climb. What's behind that?
So some cities, we are seeing cities where rent is still climbing even in today's market. And it could just be because they're a little bit behind. They're still a little bit delayed reading the economic outlook. One of the agents that I have talked to, though, did say that in certain cities where traditional market that are more popular with jobs, those cities are making a comeback now that pandemic is behind us. So somewhere like Los Angeles could be seeing a rental maybe not drop, maybe staying somewhere the same, or even raise a little bit just because people are coming back into the office and supply has not been solved in cities like this. So even though we are expecting an overall drop in rental prices in 2023, we could see a couple places where renters are still going to see a little bit of that crunch there.
So not everyone will get that relief that they are hoping for. Rebecca Chen, great stuff. Thank you. Well, coming up, we recap what we learned in today's real estate report. But before we go to break, take a look at our real estate snapshot of Boise, Idaho, with a median home price of $483,000 and median rent sitting at $1,900. Idaho's state capital remains one of the fastest growing cities in America. We'll be right back. Welcome back. Now, for the last hour, we have been looking at all aspects of the housing market, taking a look at the various regions, what is driving the housing market. And Dave, despite the challenges that remain in the near term, one overall theme I really took from today's special is the fact that so many people are upbeat about what we would likely see at the end of 2023 going into 2024. And the advice that we got from some of the realtors at the start of the show, especially in Denver, saying that don't necessarily wait until the housing price drops. Right now, she's not expecting that to really happen anytime soon. Her advice to buyers was get in now. You can always refinance. She said date the rate, marry the house, saying you could always refinance when rates drop. So that was her advice today. I love that.
I think what my big takeaway is here, the pandemic has, well, changed everything for everyone, but it really has remodeled the real estate market and it's changed the entire map. It's changed where we want to live and how we want to live. And primarily, it's put quality of life back where it ought to be on top of that list. And that's why we see maps just like this. But we see it across the country. Boise, Idaho. We see it in Phoenix, Arizona. We see it in Nashville, Tennessee. People are moving to places that their quality of life is now higher, and they're also making the same renovations that make their quality of life. And I too think the dire predictions will not come true. Low single-digit home declines in 23. This market's resilient. It's going to be fine.
Yeah, affordability really the key driver here in the housing market going forward. All right, that'll do it for us today on Yahoo Finance. Thanks so much for sticking with us.